Well, everyone knows that the stock market has its peaks and valleys, but despite the ups and downs over the long term, the market has a very consistent average. In this morning's U.S. Bank Economic 360, Vice President and Senior Portfolio Manager Mike Denneman joins Business Watch producer Kelly Leon to talk about the average and what it might tell us about where we're headed. Kelly and Mike.
Thanks, Peg. Hi, Mike.
Good morning.
Thanks for being here.
Absolutely.
So, what is the long-term market average?
Sure. It's a good place to start.
Yeah.
Like Peg said, of course, we know the market has its ups and downs, and we also know that the market can be pretty unpredictable in the short term. We could have a year with a fantastic return, or we could have a year with a pretty lousy return. But if we look over the longer term, if we string together each of those individual yearly returns, the average comes out fairly consistently to about 8% a year. So, like any average, it's unlikely that the market's going to give you exactly 8% year in and year out. But again, if we average out all those peaks and valleys, we come up with that, again, fairly consistent number.
So the market provides that consistency, that 8%?
It's a little bit uncanny, but yes, over longer term periods, it does. And again, we're talking data that goes back all the way to the 1920s. So to use a very recent example, if we rewind just a bit to the end of last year, as of 12/31, the average return per year for the last 20 years was 8.1%.
Okay.
The average return over the previous 10 years was 7.5%. So again, if we're looking at periods of a decade or longer, we're going to find the market at that pretty consistent average. But think for a minute about everything that's gone on in the last 20 years.
Yeah.
We had the tech bubble, and then the recession after 9/11, and then the housing bubble, and then the financial crisis, and then the recovery from that. So those are some pretty wild swings. I mean, we had years in there where the market was up 30% or more. We had years where the market was down 30% or more. But if we take that average, it keeps coming back to about 8%. So
interesting.
In the investment world, we call that reversion to the mean. But at base, what that's saying is that the market never really stays too high for too long, nor on the flip side does it stay too low for too long.
So you must have done really well in statistics in college. That's given that long-term average, how are we doing right now?
Sure. So important to remember that this is not a very useful tool for predicting how the market will do in any given year. But what it can do is give us some context of where we stand in the short term relative to that long-term average. So again, let's rewind just a bit. If we go back to 12/31, the previous 3-year average was about 15%. The previous 5-year average was about 12%. So those numbers in the short term are quite a bit above average.
Right.
What that's telling us is that we've come off a string of some pretty nice years in a row. But reversion to the mean would also be telling us that because we've had a string of nice years and we're so far above average in the very short term, over the longer term, we're going to have some below average years to bring us back down to that 8%. So it doesn't say that we're due for a market collapse. It doesn't say that we're in for a string of terrible years.
Yeah.
But again, the average being very consistent, at some point we've got to revert to the mean. So 2015 was actually a well below average year. 2016 has not started much better. So it just might be that we are in the process right now of watching reversion to the mean in action.
Wow. Reversion to the mean on a Sunday morning.
There you go.
Wow.
It's heavy.
Yes. But always enlightening and interesting. And I'm sure you're going to follow up with this.
Well, you know, this is kind of conceptual and theoretical.
Yeah.
But there are real applications for this for the average investor. So maybe next week we can talk about how to take this concept and apply it to your own personal investments.
Sounds good. Let's do it.
Okay.
All right. Thanks, Mike.